How are wealth management firms modernizing their technology stacks to better serve clients and optimize their growth potential in an era of personalization, private markets, and AI-driven intelligence? Welcome to the FactSet Insight podcast, where we aim to help financial professionals understand trends, solve issues, and capitalize on opportunities. I'm Dan Vento, VP of Wealth Product Development at FactSet, and I'm joined today by Greg King, head of our wealth business. Greg, great to have you.
Great to be here, Dan. I'm excited to dig in.
Let's start with the big picture. Many firms are realizing that their technology stacks have grown out of control, too many vendors, too many systems, and not enough connection between them. What are you hearing, Greg, from firms on how that's impacting advisors day to day?
It's an ironic one. Wealth management firms have never had more technology, Dan, yet it's also never felt more disconnected. And you only have to take a quick look at the size of the logos on the Kitch's wealth tech map these days to tell you how many vendor choices are available to the firms that we do business with. Firms, broadly speaking, have generally tried to avoid being tied to a single vendor over the last couple of decades. So we've had a lot of what I think have been well-intentioned decisions to buy best-in-class point solutions for defined business problems. But strategically, that's going to cause a significant amount of pain over the medium and long term, unless the right data foundations are in place and the focus is on that experience for the end user. Let me give you a simple example. A portfolio management system handles a corporate action for a security differently than your proposal or your planning tool. If that happens, the portfolio valuation will tell two different stories to the end client. Very clunky user experience for the advisor, and not a great look, if we're being honest, when proposing that updated portfolio to the client. It's probably obvious to most of us to imagine that the wirehouses and the large private banks build up tech debt of that variety over time, particularly these days with sizable grow the business budgets and typically IT staffing to support adding new capabilities each year to help scale up their businesses. But one of the interesting things we're seeing is that problem is emerging with smaller, far more ambitious firms who are using tuck-in acquisitions as a way to scale as well. One firm in particular told us that they've accumulated 8 different advisory solutions across their business. And you can imagine how that could happen. It's a perfect picture of how really good intentions, maybe continuing to modernize your tech stack year after year, turn into major operational challenges and, generally speaking, a really poor experience for the advisors. Broadly, though, I think about this as like building a bunch of houses on a street and then forgetting to run the plumbing between them. What firms keep telling us is that it's about removing the friction that slows you down. So it's okay, actually, to have 2 different systems sitting right next to one another. But those adjacent workflows should talk to one another and make sure that the handoffs from one piece of work to another is easy for the user. So the plumbing is the key to getting your tech stack right.
Right, and we've seen that firsthand, Greg, with clients consolidating tools, combining portfolio management, analytics, and client engagement workflows into more unified work streams. And it's not just about cost savings. It's about enabling better and faster decisions and user experiences for the advisors and both their end clients. The second theme we're hearing a lot about is access to private markets. Clients are looking for broader diversification opportunities beyond traditional stocks, bonds, and funds, but integration of private market and private and public market assets in one portfolio framework is easier said than done. What's driving that demand and how are firms adapting?
Yeah, good question, Dan. For years, the traditional 60/40 worked just fine for most firms. But in a world of lower yields and, broad to say, oversaturated public markets, investors are rethinking where to find alpha. Clients in particular are getting more savvy every day, and they realize that private equity, private credit, real estate, and other private assets can provide some of those uncorrelated returns that potentially drive better outcomes. We know institutions have long used these to smooth volatility and to generate alternative sources of return. Now, though, affluent investors want in, and the US government's recent executive order to open access to 401k plans, I think, brings us closer to that democratized access for all investors. And the risk appetite on the part of those communities is changing up and down the wealth spectrum. I'll give you an example that I heard earlier this week. I was reading an article that Morgan Stanley had announced removing what was previously a $1.5 million wealth threshold for clients who are interested in crypto funds. Now, there may be a little FOMO impacting that decision. In fact, a friend of mine told me that their college endowment can invest in private credit, but he specifically can't. But I think there's also a symptom of public markets not providing investors what they want. So wealthy and affluent investors alike will seek returns wherever they can find them. And all that said, it's not just a question of democratization. This space also needs to sort out the plumbing to make investing in private assets more like investing in public markets. Those 50-page prospectus documents need to be parsed and databased for exchange between the GPs and the LPs. And then they need to be normalized so that research departments can run that due diligence for fund selection. The good news is that firms like iCapital and Case are helping to provide a marketplace for these instruments, and technologies like Subscribe are getting us in a position to take you from research to implementation with a seamless, quote, buy button. But the last thing I would note in this space in particular is that the business of combining public market and private market sleeves together for a whole of portfolio analysis and reporting is that critical last mile. We at FactSet have a lot of experience with this from a decade ago when we had to put equity and fixed income together to allow portfolio attribution to be done in different asset classes. So I guess the good news, if you're looking for it, is that there are solution providers out there for all of these private market challenges.
Yeah, exactly. We've worked with firms integrating private fund data directly into their proposal generation reports and advisor dashboards so that the private public mix is reflected consistently from initial recommendation through to performance reporting. All right, let's talk about AI. Everyone else is talking about it, but the real question is, where does it actually create value for advisors?
I knew it was coming up eventually. One of my favorite anecdotes in this space in particular was from a COO at a wealth management firm in Hong Kong I was meeting with a couple of months ago, who told me that it takes 2.5 hours for our advisors to prep for client prospect meetings. And I was sort of scratching my head. I thought to myself, actually, that's not too bad, until he followed that up with a comment that they goal their investment counselors and investment consultants on 3 meetings per day, which means they're unlikely to be getting home for dinner most evenings. And I think that's one of the very exciting potential uses of AI right there. Repetitive processes that take time, particularly data gathering exercises, are where AI offers unbelievable possibilities. That 2.5 hours of work can likely be translated into 30 minutes of fine tuning by the human advisor after the AI generates meeting notes, pulls talking points from the CRM, summarizes the latest CIO office research, and then pulls some of the latest products from the firm's approved list to offer the client in the meeting. And I think we're at that stage now where everybody's talking about what AI might do, but the really smart firms are already quietly using it for what it actually does today. I'll give you a couple of examples of that. Prospecting and proposal workflows are great practical use cases for AI in biz dev work, as are some of the summarization tools that we're seeing in the market. There's lots of new tools out there for meeting notes and visit summaries. The other area of recent development that has been around gathering insights from the home office or the CIO's research and doing portfolio performance summarization on client portfolios. That's an area I think that's likely to mature and scale really quickly with AI, with its skill at storytelling in particular, because we always have to remind ourselves that wealthy clients are not always financial professionals who can analyze business balance sheets and income statements every day. From there, I think the real opportunity for AI, looking a little bit into the crystal ball, is to extend it deeper into the investment solutions for client portfolios, and to give the wealth managers the ability to make suggested trading and rebalancing decisions. It'll be important, obviously, to have a healthy dose of oversight in that space, factoring in all the client constraints and guardrails a firm wants to place on the AI. Things like approved and restricted lists are obviously there, but regulatory requirements will need to be incorporated into that decision making. But it does offer the potential of real efficiency in the run the business areas of the firm, and it frees up the advisor to spend more time with their clients. I think the key is to put the advisors at the center of the decisions you make with AI. If every advisor suddenly had an analyst, a writer, and a researcher working behind the scenes with them, or ideally sitting in a client meeting with them, that's what AI feels like it's done right. At its best, though, it's a little bit like having the perfect intern. It's fast, it's tireless because it can work all day, and it's getting smarter every single week. So I'm really excited, Dan. I think the future of the hybrid model has huge potential for us all.
I love that framing, Greg. AI as a co-pilot to drive efficiency, alignment, and better client outcomes at scale. We've seen firms using AI-powered prospecting, as you mentioned, to monitor and surface signals that would have taken hours to find manually. Advisors can now spend that time having deeper, more meaningful client conversations instead. If we maybe take your crystal ball back out and look a little bit further down the pike, looking ahead to the next few years, what separates the firms that are going to thrive from those that fall behind?
Well, I think the winners will do primarily two things in my mind. First, they're likely to recognize that in order to scale their businesses in a world that will at some point be dominated by AI and interconnected technologies, wealth management firms will need to start with the foundations of the house. The good news is that it's not too late for most firms. Get your data in order before you do anything else, so that these incredible technologies are able to produce high quality output for the advisors and their clients. We've all learned over the last handful of years now that the large language models are desperate to give you answers, but they can only give you the right answers if you have the right data to interrogate. So that's point number one. I think the second thing that the winners will do is get ready to be aggressive when they get their house in order. And it's been, as I said, 3 years now since ChatGPT was first launched. It's fair to say that the wealth industry hasn't changed a huge amount in that time. That said, this feels a little bit like the internet. The revolution didn't happen as fast as we expected with the internet, but we can all agree that it was more impactful than we anticipated once it matured. In the software world, we talk a lot about early adopters and fast followers. In my mind, we've had 3 years of learning, and the firms that will win as the fast followers will take those learnings and take a very hard look at their operating model of the business and pick out the specific areas of improvement. A little bit like that 2.5-hour meeting prep that I was describing earlier, and then aggressively invest in making their advisors more efficient. If the management consultants are right, and there will be, what did they say, 100,000 fewer advisors in 2035, I think that's what McKinsey told us, than there are today, we're going to need technology to allow the remaining advisors to look after 2 or 3 times as many clients as they service today.
And I'll double down on some of that, Greg. Those that connect advisor productivity directly to client experience are the ones poised to see the biggest gains. Greg, this has been great. Thank you for sharing your insights. For those listening, if you'd like to learn more about how wealth firms are transforming their advisor workflows, check out the latest at factset.com/wealth. I'm Dan Vento, and this has been FactSet Insight. You can find all of our episodes on Apple Podcast and Spotify. Thank you for listening.
The FactSet Insight podcast is for informational purposes only. The information contained within is not legal, tax, or investment advice. FactSet does not endorse or recommend any investments and assumes no liability for any consequence relating directly or indirectly to any action or inaction taken based on the information contained in this podcast episode. The views shared by third-party contributors do not necessarily reflect the opinion of FactSet.